What would you do if the global financial system as you know it was on the brink of collapse? All because a handful of nations decided to defy the US dollar. And what if that rebellion was fueled by China wielding the one resource the US can't live without? In recent months, the United States has aggressively pressured BRICS nations to continue conducting international trade exclusively in dollars. At first glance, this might seem like a logical move to maintain economic stability, but beneath the surface lies a startling vulnerability. The US dollar's dominance, also known as the petrodollar system, underpins much of America's geopolitical power. A recent report from the Wall Street Journal highlighted how 88% of global trade is settled in dollars. However, BRICS nations, representing 41% of the global population and over a quarter of the world's GDP, have begun experimenting with alternatives like the Chinese yuan and even gold-backed currencies. This shift threatens to erode the dollar's role as the default reserve currency, potentially destabilizing U.S. markets. Dr. Michael Hudson, a prominent economist, notes, "The reliance on the dollar as the primary trading currency is as much a liability as it is an advantage. Any coordinated effort to challenge this dominance could unravel years of financial stability." Please like and subscribe. Leave your thoughts in the comments. Your support helps us grow. Thank you. Former President Donald Trump recently proposed imposing 100% tariffs on imports from BRICS nations to counter what he describes as their anti-dollar agenda. While this might rally some domestic support, it risks igniting a full-blown global trade war. A study from the Peterson Institute for International Economics warns that such tariffs could slash global GDP by 3%, plunging economies into recession. Moreover, BRICS nations hold critical leverage. In 2022 alone, the U.S. imported over $480 billion in goods from BRICS countries. These include essential commodities like rare earth metals, which are indispensable for technologies like smartphones, electric vehicles, and even advanced weapon systems. Economist Nouriel Roubini adds, "A trade war of this scale could fundamentally restructure global supply chains, but not in America's favor." The dollar's global dominance is often portrayed as an unmitigated strength, but it comes with a paradox. To maintain its role as the world's reserve currency, the U.S. must run trade deficits to supply dollars internationally. This creates vulnerabilities as the national debt, now exceeding $36 trillion, balloons further. According to Nobel laureate Joseph Stiglitz, this system is unsustainable and could implode under the weight of de-dollarization efforts. The contradiction is clear. While the U.S. urges other nations to use the dollar, it exposes itself to heightened dependency on foreign creditors, including geopolitical rivals like China, which holds over $870 billion in U.S. Treasury securities. As Paul Krugman wrote in the New York Times, the dollar's dominance is not just economic, it's political. But that political capital is being eroded by policies that appear increasingly self-serving. China has aggressively promoted the yuan as an alternative to the dollar. Recent agreements with countries like Saudi Arabia and Brazil to settle oil and agricultural trade in yuan signal its growing acceptance. According to the Bank for International Settlements, yuan-based trade settlements have increased by 25% over the past year. Experts like Eswar Prasad, a Cornell University economist, argue that while the yuan is not yet a full-fledged reserve currency, its increasing use in bilateral trade agreements could accelerate de-dollarization. For example, the China-Brazil deal alone shifts billions away from the dollar annually, impacting U.S. financial markets. The yuan's rise is less about overtaking the dollar and more about creating a multipolar currency system, notes Prasad. China's recent decision to restrict exports of gallium and germanium, two key minerals in semiconductor production, has sent shockwaves through the tech industry. The U.S., which imported 98% of its gallium and 80% of its germanium from China in 2022, now faces a critical supply chain crisis. According to the New York Times, this move is part of China's strategy to counter U.S. sanctions on its tech sector. The Semiconductor Industry Association estimates that disruptions in these supplies could cost U.S. companies up to $3 billion annually and delay advancements in technologies like AI and 5G. Professor Chris Miller, author of Chip War, explains. The semiconductor industry's reliance on rare materials makes it especially vulnerable to geopolitical maneuvers. The stakes go beyond consumer technology. Critical minerals like gallium and germanium are vital for military applications, including radar systems and satellite communications. Losing access could compromise national security. Additionally, the electric vehicle or EV sector, a cornerstone of the Biden administration's climate goals, depends heavily on these minerals. Bloomberg NEF reports that U.S. EV production could drop by 20% without stable supplies, jeopardizing both economic and environmental targets. General Motors CEO Mary Barra has warned, a disruption in mineral supplies would be a significant obstacle to achieving electrification goals on time. China's dominance over rare earth minerals isn't accidental. Decades of strategic investments have positioned it as the supplier of 70% of the world's rare earths. These minerals are essential for everything from wind turbines to fighter jets. Beijing's export restrictions, announced in July 2023, are a calculated response to U.S. semiconductor sanctions. Dr. John Lee, a senior fellow at the Hudson Institute, calls this a geopolitical chess move designed to force Western industries into reliance on Chinese-controlled supply chains. De-dollarization isn't just a theoretical risk. It's happening. BRICS plans to create a unified currency for intra-block trade could drastically reduce global demand for the dollar. According to the International Monetary Fund, a 10% drop in dollar-based trade could shrink the U.S. economy by 1% annually. The real danger lies in the domino effect. As BRICS nations opt out of the dollar system, other countries, from Indonesia to Turkey, may follow, amplifying the economic fallout. Economist Mohamed El-Arian has emphasized, the move away from dollar-centric trade is both a symptom and a cause of shifting global power dynamics. The U.S. finds itself in a dilemma. Policies that prioritize Wall Street often come at the expense of domestic manufacturing. For decades, cheap imports, often from BRICS countries, have fueled corporate profits while hollowing out American industry. Now, as geopolitical tensions rise, rebuilding manufacturing capacity has become a priority. Yet, this shift clashes with the financial sector's dependence on globalization and free trade. Economist Jeffrey Sachs notes that resolving this contradiction is critical to maintaining U.S. economic resilience. China's control extends beyond rare earths to other critical materials like graphite and cobalt, essential for EV batteries. In 2023, China supplied 79% of the world's processed graphite and 68% of its cobalt, according to Benchmark Mineral Intelligence. Recent U.S. efforts to diversify supply chains, including partnerships with Canada and Australia, are promising but insufficient. Analysts warn that China's ability to disrupt these markets could stall the global transition to renewable energy. Without a reliable supply of these materials, the EV revolution could grind to a halt, warned Simon Moores, managing director of Benchmark Mineral Intelligence. The mineral export ban represents a significant escalation in the ongoing tech and trade war between the U.S. and China. While the U.S. has imposed sanctions on Chinese tech giants like Huawei, China's countermeasures could cripple American industries reliant on advanced materials. Harvard professor Graham Allison describes this as a Thucydides trap, where a rising power, China, and an established power, the U.S., risk descending into conflict. A coordinated BRICS retaliation, such as collectively reducing dollar-based reserves, could have catastrophic effects on global trade. The Federal Reserve would face mounting pressure to stabilize the dollar, likely leading to higher interest rates and a prolonged economic downturn. According to Financial Times, even a modest shift by BRICS away from the dollar could devalue U.S. assets by trillions. China's approach to resources is methodical. Decades of investments in mining, processing, and infrastructure have given it unparalleled control over global supply chains. Meanwhile, the U.S., focused on short-term profits, has largely outsourced these industries. This strategic imbalance leaves the U.S. vulnerable to supply chain disruptions. As analyst Daniel Yergin notes, China's long game is winning the economic war. Could the U.S. survive a fractured global supply chain without reliance on China? The short answer is no, at least not in the immediate term. Rebuilding domestic industries and forging new alliances will take years, if not decades. In the meantime, the U.S. must navigate a world where its economic power is increasingly contested. As the BRICS nations chart a new course and China leverages its mineral dominance, the U.S. faces an unprecedented challenge. Will America adapt and reclaim its manufacturing strength, or will this be the beginning of its economic decline? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.